Ladies and gentlemen of the crypto space, we're live on a Friday, March 10th at 11:34 a.m. Today's an interesting day. It's an exciting day. We haven't had volatility like this in the entire financial system for the better part of 12, 13, 14 years, 2008, give or take. It's uncommon for these types of scenarios to emerge, but it's a result of volatility. And in this instance, the volatility is associated with the price of collateral. Now, we've seen this type of behavior for folks. This is a crypto-centric channel. We see this when prices are volatile on money markets like Aave, or what happened with Abracadabra, or other types of environments where the pricing of posted collateral gets to the point where it breaches a liquidation threshold. That's not what occurred with what's going on with the banking system, um, because the banks have rules, and the rules are set by basically the Federal Reserve, as well as Congress and uh, the OCC. And those rules are to help mitigate risk, but they're ultimately set the reserve requirement at 0%, and they decided to depreciate bonds at the fastest pace in basically history this year, well, 22. And that's why what's occurring is occurring right now. Um, it plays into what I've been talking about recently with euro dollars and the notion of hold to maturity baskets of a portfolio. If you have a collateral instrument at $100 and its face value is $100, but the market is depreciating and it goes to $95, it's going to pay $100 face value when the instrument reaches maturity. And that is the base case for all hold to maturity baskets in all of these banks. There's zero reserve requirement. So then it comes into like how much collateral needs to back deposits. And those are some of the rules that the central bank created for banks, commercial banks. So in this instance, let's say a bank has X amount in hold to maturity. They expect to get X amount of dollars when it matures. But in this instance, retail, the general public, has been removing money from banks. Why? Because inflation is high. Prices of goods and services require less deposits in banks. People have to spend the money to accommodate their lifestyle and food, so on and so forth, staples. But also because the yield on bonds from stuff like Treasuries Direct has been high. So there has been a general trend for capital to come out of banks. So what happened was to balance the books at these banks, I'm not even naming the banks, they had to come up with cash. So they sold their bond portfolio at significantly depreciated prices, and it was a portfolio that they weren't not supposed to sell. They shouldn't have had to sell it. You hold it to maturity, you get face value. So that's why it broke, because retail has been pulling their money. In fact, that's I guess it's a bank run, but the whole point is it's such a perverted system. We have too many people pull their money out of a bank, it breaks the way the bank is designed to operate. And that's just not a bank. It's a perverted bank. It's not. It's what the banking system has become over the last 100 years, or maybe more recent. It's gotten more perverted. But if a bank doesn't hold 100% of my goddamn cash, it's the stupidest concept I can imagine. It's horrible. That's not reasonable. But that's what is. So the bank needed to come up with cash. They had to sell a shitload of bonds that they weren't supposed to sell. It was in an account, a hold to maturity account that wasn't supposed to be sold until the bonds matured, and they got face value for the bonds. What an insane situation! But I don't see why this won't cascade. It's not gonna, and then it's like, oh, it's not gonna cascade to like J.P. Morgan and bigger banks, and then it does, and then it, but you never know if it's not. Maybe it won't, and it's the whole risk profile of what we do with our cash. Do we have cash exposure to these banks? Do we have cash exposure to Schwab and Fidelity? And what are they doing with their books? This is why I appreciate the crypto space so much. I know how much of an asset I have. I know where it is. We know the portfolio of protocols is completely on chain, is completely open. We have our risks that we deal with. Like this morning, I converted USDC over to LUSD, and that's my stablecoin position. LUSD has absolutely no direct exposure to uh, regulation, really, being that it's an immutable protocol. The risk is associated with the organic nature of the peg, arbitrage, and incentive systems of late that they've been financing to manage peg operations. And there's risks. There's risks with everything. There's risks going to drive your kids to school in the morning. Us as humans could only really engage with life assessing the degrees of risk we take in everything. So make your choices accordingly. And and if you're making a choice without knowing the risks involved, it's not a good choice. I was thinking this morning also, I have too much cash in one particular bank, and that's a risk, and it leaves me uncomfortable. And my wife will chuckle sometimes that I feel uncomfortable over things that she's not accustomed to feeling anxiety over. And a lot of my family, my extended family, my wife's family, they don't understand a lot of these thoughts. But, if risk is going to happen, at least I know it's coming because we talk about the things that we're talking about right now. So, you know, contagion. If a bank goes down, it's going to bleed over into other banks and it just cascades through the whole system. To the point where literally this morning, they're not going to be raising rates. They're not going to be raising the 50 basis points. Um, I say that I said that very assertively. Watch them raise 50 basis points. But there's your risk because it's people, it's humans. It's not deterministic. Everyone's like, oh, this morning they can't raise 50 basis points. The collateral is too cheap. They need to raise bond prices. So the banks have a hold to maturity portfolio component that's more healthy. They're more collateralized. The value of the collateral. So maybe they do raise 50 basis points and they're like, oh, we could let go of a couple of banks. The biggest systemic risk, they're overwhelmingly capitalized and collateralized with regard to health conditions. Um, I hate that. I'm not going to engage with that type of thought experimentation. Oh, they're going to raise rates to 50 basis points. Oh, this morning, oh no, they can't do that any longer. Everything I've talked about on this stream for the last 2 years is a new way, a different way, a sustainable way to engage with markets, or at least to manage the portfolio. I've done nothing. I've done very few things. What's the point of me saying that? I've structured the portfolio. I spent all of 2022 achieving a portfolio that doesn't really need to respond to, is the Fed going to raise rates? Is it going to lower rates? Is there going to be bank contagion? So I've minimized the amount of actions I need to take if I identify something that even warrants me taking an action. If I can't change the outcome of a certain sequence of events, there's nothing I could do. So if there's a you know a volatility cascade amongst banks and there's an issue with some of the banks, I do have a little bit of exposure to FDIC insurance limits. You know, I probably could have done a little bit better in that regard. You know what I'm most worried about? It's not necessarily the FDIC insurance limits. I'm most worried about my capacity to convert stables into a debit card. So Juno, BitPay, I rely so much on that functionality in my day-to-day life. That would be the most disruptive thing for me right now. If I can't put stablecoins on a debit card. So I'm very hopeful that Juno and BitPay continue to function as they've been. Isn't that interesting? That's my worry. Like, I know I'd be very upset if the banks I have cash deposited with have issues. I'd be very upset if I had to engage with FDIC. That'd be a loss of money. But I've said over the years, it's not about the money you have. It's cash flow. Cash sitting, cash savings, cash flow is still more important than cash sitting and savings. So for instance, I think often about a catastrophe. What if society starts breaking down and the banks start failing? I still have a capacity to do the work that I can do. My skills, my programming skills, my capacity to do due diligence and risk assessment, and my knowledge of history and everything I've done over the last couple of years and shared with you guys. So I'm productive. So that alleviates a lot of my concern about crisis type scenarios. So I'm not too worried about the bank accounts. That'd be annoying. That'd be more annoying than it offering me something to be worried about. The biggest thing that worries me, really, as I just said, was Juno and BitPay not functioning. So just put that into perspective with regard to where I'm at mentally about what I'm worried about. I'm not worried about the price appreciation or depreciation of the assets in the portfolio because it's not about the principal valuation. It's about the weekly cash flow. And that's going to go down. It's down significantly over the last 2 weeks, but it's still there. And you live your life based on cash flow. You don't live your life based on what you have because if you spend what you have, it's gone. So you want to own things that are paying you week after week, and your whole life is dependent on the cash flow that it produces. And if it's producing less, you can do less. And you get into periods of austerity. We said that all year long last year in 22. It was austerity. We have less money coming in, so adjust accordingly. Could be some nice discounts emerging in the market. Let's pop it over to the main screen. Where is my charts? I mean, I can't believe the S&P just pushed back above the 200 SMA on the daily. The market screams of just volatility. Like this morning with a big bank failure, the largest bank since Lehman Brothers, it's still not contagion with regard to risk markets, with traditional risk markets, equities markets. And it's all about sentiment. So this type of sentiment that's going on in the equities markets that you're seeing on the screen right now is going to play over into the sentiment brewing in crypto. If you're seeing this go up, you're going to generally see risk exposure in the crypto markets go up as well. Now we've talked over 22 about like decoupling and sentiment is a common denominator, liquidity is a common denominator, and we talked significantly in 22 about the difference between international liquidity and domestic U.S. liquidity. So this is a correlated type of observation. I don't even have to look at the crypto space. If you see this up, you're generally going to see the crypto markets up. And the contrary as well. If this goes down, because the sentiment is a common denominator. It'll be very interesting if we see liquidity conditions significantly increase outside the United States versus domestically, and that is a pressure that would be along the lines of decoupling. So what happens is what you should see in markets is pressures, and pressures are either in the same direction, a synergy, or they counteract one another. So sentiment is a correlated pressure. It's the same across all markets. And liquidity conditions is the same effect on markets, but the liquidity can be different in different parts of the global market, international versus U.S. domestic, as we've been discussing. So today is a story of sentiment. And it looks like sentiment is it's not systemic. So I bet you those Fed funds uh, futures are going all over the place. Like this morning, it was like, oh, they're never going to do a 50. I mean, it was like 60, 70%, 50 basis points, like 2 days ago. I bet you, and this morning, didn't we see? I believe it was 25 basis points, and it's probably going to be zero if everyone was freaking out. And I bet you it popped back over to the 50 basis points at this point. So what is that? That's volatility. Nobody knows what the fuck is going on. So volatility is a big thing we've been talking about all last year. And resonance, that's another big word we've been talking about. The Fed has created a significant amount of resonance in the system. Things go up very quick and things go down very quick. And they obviously depreciated bonds very quickly. Let's take a look at the 10-year. 2 years come down. Everyone's screaming about how fast the 2 years come down. That's on the yearly chart. It's not really looking down to me. And everyone's like the resurgence of risk off and the bond bull is not over. That doesn't look very risk off to me. That looks marginal. Now, intraday very much looks marginal. Structurally, it looks like nothing has occurred. And I've told you guys I don't really give a shit about the daily charts anymore, and the weekly charts are starting to annoy me. I've been looking at the monthly charts and the 6-month charts. Don't have that kind of history here in the 2-year. Let's look at the 10-year. 10-year log I want to look at. So there's something I noticed about like 10-year. Like if we have a strong risk off, like a traditional risk off where bonds go risk on and the price starts appreciating and equities just go risk off, they'll have to cut rates. It'll be that type of sequence of events that everyone's accustomed to, where contagion is spreading and everything is depreciating, except bonds, of course. But it's a very interesting position on this chart. And this chart is right down the pipe of the yield curve. So this is kind of grossly in aggregate representative of the state of the bond market. Short end behaves very differently than the long end, but this is, a general representation. Could you see in like a year, 2 years, risk off, big banking crisis, and bonds go risk on, and the 10-year yield retraces to the white line, 2.6%. A little less maybe, a wick below, but it holds the white line as support. That's a structural change to everything we've seen since the peak in 81. And that is something that looks structurally reasonable to me. Fine, we have a risk off and everything behaves accordingly with regard to the bond market going price appreciative ferociously. I mean, look how price appreciative it was in 22 and 20. That's a heck of a going risk off and everyone just buying bonds. That is massive. But the intervention would be the cutting of rates and it finding support, yield, 10-year yields finding support on the white line. And that would be resistance, 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 a breakout, retest of the white trend line, and then a higher high in the coming years, 5-10-year time horizon, 4.85. That's a directionality change. It takes that many years for these types of systems to play out, which is why I'm not even really looking at the 1-month chart anymore. Take a look at the 6-month chart. All right, let's get 4, 5, 6 candles on this bad boy. Let's check back in 3 years, 5 years. You can't operate in these markets day to day. absolutely drive you nuts. I'll check back in 3 years, 2.6% in 3 years, and you have a trend directionality, a reversal, a directional reversal, a trend breach, a breakout, a retest, and then the higher high in, let's say, 5 to 7 years or more. And that's what this chart suggests to me, that structurally the system has changed, and that's what we've been talking about with regard to Peter Zeihan's work on demographics and peak globalization, which is just obvious geopolitically. So, you know, anyway, so don't let days like today drive too much anxiety through you. Trends take a long time to play out. And overall, the market looks relatively good to me. Give it another 2 months. Well, it's March, April, May, June. Another 3 months, and you really get a sense of what the hell is going on with the dollar. It looks like it's putting in a little bit of support on the monthly TWAP. You know, generally, if the dollar breaches this to the downside, that means liquidity conditions are going to significantly improve in the rest of the world, and that gives you that liquidity decoupling that I've described, where the rest of the world is liquidity flush, but with relatively high interest rates in the U.S. and other complexities that we're experiencing domestically, higher CPI prints, there might not be as much liquidity in the U.S. So that means internationally, they're free to do more risk exposure, and that could have a very significant uh, effect on the crypto markets, because crypto is not a U.S. market. It's a global market. So why can't liquidity significantly flow in outside the U.S. and liquidity stays about a little muted inside the U.S.? And that's a structural change to how capital is flowing through the system and where it's flowing into and out of markets from. So to see international liquidity conditions, we look to the DXY. And domestic liquidity conditions, we're looking to interest rates, and we're looking to M2, and M2 is contracted. There's been like 5 or 6 contractions over the last 150 years. I've seen a couple of nice charts floating around. And the last time we had a negative M2 was the Great Depression in 29, but that was a massive decrease in circulating currency. 1921 was about 2%, and we're at 2%. The 1921 recession crash, and we're at about 2% reduction in M2, and that's big. So that's more so domestic liquidity conditions. International liquidity conditions, LIBOR is getting phased out, and everyone's going to have their respective, risk-free rate. But the point is, that's really the euro-dollar system, because so much of the world is dependent on dollar-denominated payments. That's the liquidity condition that's interesting. So dollar comes down, increases global liquidity. Interest rates go up, I've argued, increases global liquidity. So if the interest rates stay high and they don't really drop, they maybe a 25 basis point hike, even if it's zero, the interest rates are still relatively high, which means bonds are still significantly depreciated as compared to December of 21. So and then you get the seesaw effect between where you get your dollars from. Do you buy it from the forex market, or are you able to get your hands on bonds, risk-free U.S. bonds that are cheaper than the forex market rate for $1, and then you're able to take those bonds, give them to a euro dollar bank, and do exactly what we've been shown has occurred here. You put the Eurodollar bank puts them in a hold to maturity account. They give the depositor, or the person taking a loan, you want to classify it as a loan or a deposit, gives them maybe not face value, but close to face value. But whatever they give them in dollar liabilities is at a better rate than what they could have gotten on forex markets. So there's your seesaw between either bonds or the forex market being used to acquire dollar liabilities. You go into the forex market, the odds are you're not getting physical dollars. The odds are you're getting dollar liability of some form anyway. So even dollar FX is really goddamn dollar liabilities. It's all dollar liabilities. Why? Because if you look at M0, there's barely any dollars in existence as compared to the amount of dollars that the world is using and is dependent on. It's all a big shell game slash Ponzi scheme. You all know that. 32 people in the stream, 10 likes. I appreciate all of you. Hit that thumbs up button. Killis, good morning. No horns, no tail. Hey, Cap, great day to have a day. It's a good day. This is exciting. This is interesting. We get to see people that think the system is stable realize it's not really that stable. This is where we get to poke the bear. We get to poke the Fed. Like, what the fuck are they going to do? Their banking system isn't really that great. They poke us with the New York Attorney General doing what they're doing with the crypto markets, what they're doing with KuCoin and trying to inject a couple of legal perspectives into their argument. So everyone in this planet is trying to poke everyone to try and express their interest and move the system in the direction they want it to move. So I find it interesting on days like today. This is not a big anxiety day for me. For for me, I go over to good old vote market. How much cash is available next week? Pretty good numbers. Aura will come back in when that vote cycle starts up again, and this will probably be around 900 to 1.2, give or take, depending on that. Those available financing conditions, how much capital these protocols have to finance their respective liquidity desires. But overall, what is this? This is curve, so that's the vote. Let's look on the aggregator. Some good numbers floating around. Curve still has cash, and they print that obviously from their transaction fees, their admin fee, of which they get 50% of it, and the other 50% goes to VE depositors. So there still is some nice cash floating around. Balancer has some nice cash floating around, some nice rates of return. 10 cents per VE BAL is quite lucrative, which is why I've talked on Discord about my interest in BAL versus Aura, but it turns out I'm probably not going to do anything. I'm quite content with having the respective position sizes at what they are. So I'm going to be relocking my VO Aura, and I have my VE BAL, so this is nicely productive actually. Where was it? FRX ETH and WETH. This is straight from Frax, and that's stablecoins. 10 cents per VE BAL in stablecoins. If I could get an extra $300-400 a week, I'm not complaining whatsoever. So this is very nice to see, reassuring. And what's more important is if you go over to the Warden, or just an interesting add-on to everything we're talking about. Bunny has been included in the Warden. So there's some cash there. Obviously, these are completed. We've talked about these over the last couple of days. I expect this to head in the direction everyone expects it to head. Protocols, Badger, Frax, Liquidy's already in here. But anyone that has capital on Uniswap is going to want to incentivize liquidity and finance that depth. It's in the best interest of the protocol. And even if you have assets on Curve and Balancer, there's going to be a requirement for liquidity on Uniswap, because what we've discussed is that no matter how much better other AMM protocols are, there's a contingent of crypto participants that only engage with Uniswap, and they engage with nothing else, and they literally go to like uniswap.org. They don't use aggregators, they don't use 1inch, they don't use the Llama or Paraswap or whatever, what have you. They just go to Uniswap. So this is a very meaningful protocol, in my opinion. Obviously, how meaningful it is, time will tell that story. But thus far, this looks very interesting. I keep my eyes on their Discord. They have some nice votes going on. Badger's getting involved. They just had a vote to add a gauge. So this is interesting. So on a day when everyone's freaking out in traditional finance, all I do is see interesting things. I might be experiencing austerity. I might have less income next week, less of a salary, but holy fuck, that's just great. Don't let yourself get hung up with volatility driving you mad. Very easy for it to drive folks mad. Let's look at Ethereum. Here, let's look at Ethereum. Check this out. This is my perspective, folks. Let's look at Ethereum. That's Ethereum, the history of Ethereum, all of Ethereum. This tiny little chart on the perspective that matters most. A 6 month chart or a yearly chart. And then everyone's like, you can't get any information out of that chart. And that's true. You're not going to get any information out of that chart. But that's the perspective that matters. So, you dig in a little bit more granularly. You go to the monthly. But is the monthly the chart that really matters? Only you'll be able to tell yourself what matters most to you and how you're able to quell your anxiety and navigate the markets most optimally. So I generally look to the shorter time frame charts when I don't have a longer time frame chart, and in the crypto space, that is almost always the case. You just don't have the longer time frame charts, so we're forced to look at the shorter term charts, but don't let them get to you, because we've been saying this entire stream that it's really the longer time frames that matter. The shorter term is just noise. What matters is surviving. What matters is navigating. What matters is really Friday. Friday matters and how much cash you got on Friday. And what matters is if you're worried about banks, you have cash, like dollars, literally physical paper money. Because if the banks fail, everyone's fucked, and it doesn't matter if you had 200 grand in a bank account, because everyone else is going to lose all their money also. And maybe FDIC kicks in, you get your money in a couple of days, and they're able to stabilize the system. But everything's going to be a shit show. If FDIC has to engage, it's going to be an absolute disaster. So what matters? Friday. Did you have cash? Because cash, you could pretty much convince anyone to give you something. All that matters is Friday. So it's funny because it's a bit of a contradiction. I say 6 months charts are what I'm looking at nowadays. And then I say the 1 month, the 1 week, the daily chart, they'll drive you nuts. And then I come in and say all that matters is Friday. So maybe what that means is to understand the system, you want the longer time frame perspective, to understand the directionality of the system. Longer charts, the shorter charts will drive you nuts. The short-term directionality of the system doesn't matter much. And then Friday, you have cash so you could actually feed yourself. So it's kind of like you want the data so your mind can wrap its head around where the system is heading, the structure of the system. And that's like the higher level parts of your mind. So that quells your anxiety. And then you need to cater to your old school reptilian humanity that you're able to acquire consumer staples on Friday. On Friday, which means you're not the daily chart. It's two separate phenomena. You need to know how much money is coming in on a weekly basis, how much consumer staple credits you have so you could actually feed your reptilian humanity. And then you need your longer time frame data so you could cater to your not reptilian humanity, because that's the cerebral cortex, and that's what makes a human a human. We have this capacity to visualize and understand these very abstract structures that we've created as humans. And those occur and play out over much longer time horizons. So Friday If you're covered, you shouldn't have much anxiety. And then you structure, what skills you're learning and how you manage your financials to cater to the longer time horizon. And that means you're covered in both ends. Then you're covered in the short term and the long term. And that's how you win. You win by finding your path of engaging with this shit show we call experience life by hedging. So you hedge the short term with the long term. You hedge, can I actually feed my family on Friday with having the knowledge, the data, and the education, the learning? This is education and learning, what we're doing right now. So you prepare and hedge the short term, trying to prepare for the long term. So that's how I get on a stream today and smile like, all right, we got this covered. I'm not worried. We know how to navigate. Sailors. Stands in the house, kill it. Any pizza shops available in current conditions to get into if you were new in the space? Well, that was exactly what we were showing. Do I have it up? Yeah, here's Lit Timeless, which is the bunny product. With the depreciation, it's cool. Um, this is an interesting potentiality. I'm more fond of what this is potentially offering as compared to where I was solidly. I don't mean to keep talking about it in a negative way. I had very high hopes for what solidly could offer, and obviously the forks on L2s have done quite well. But I just don't see. I see it as a crowded space now on mainnet. And even with superior tokenomics, what have I said historically? Better tech doesn't mean much. You can have the greatest tech in the world if you're first to market and you're not going to disrupt an ongoing disruption. Microsoft still dominates Apple. Apple has no chance in taking over business. Microsoft wins. They own it to this day. So in that regard, Curve is entrenched, Uniswap's entrenched, and somehow Balancer has been able to carve out its own uniqueness. Thus far, that's what I see. And what are the three characteristics of those protocols that tell me they have momentum? And it's the only one of two things that are meaningful in the entire crypto space that I talked about on a tweet the other day. One was immutability, two was the currency recycling regimes. So what attribute of Uniswap, Curve, and Balancer firmly establish them as entrenched? Uniswap is getting a currency recycling regime bootstrapped by the Bunny protocol. Uniswap is entrenched because it was the first. It has the Bitcoin momentum. Curve is the originator of voter escrow, so it has all the third-party vote rental cash flow through Convex, through the other protocols, Concentrator, and there's a bunch of others, and VE Curve directly via Vote Market and Warden. That's a huge amount of cash flow. It's millions of dollars a month. Yeah, Convex still has. I haven't even looked at Vodium in quite a while, but I'm pretty sure it's still much larger cash flow than what's going on in Vote Market and Warden. And then if you look at Balancer and Aura, that's a huge amount of cash flow. And that's good to see. That's the attribute, the one of the two attributes that tell me these three protocols are not going anywhere. And that's not really what I see for solidly right now. So this isn't, I'm not here to bash, but if you go over to bribes, is there any bribes? Is boat rentals? Is there anything? I don't see anything. So, that doesn't mean they don't come, but that also means it doesn't have the attribute that I look for, that I want to see, that I believe and I have identified as the most meaningful attribute for a protocol to have for it to actually work. So would I love to see, you know, two, three, four, 500,000 a week worth of bribe? Yeah, sure. If I saw that, I'd probably be buying. That's it. Simple as that. So I just don't see what I want to see. And that's okay. Doesn't mean it can't occur. It can occur, but I'm not in a position to be taking that speculation. In these tightening liquidity conditions, I don't want to take on that speculation that those more favorable conditions will emerge. Whereas with Bunny and Uniswap has the liquidity. It's got 3.4, $3.5 billion worth of liquidity. And we already see vote rentals starting. And it's so much sooner than what we've seen with other protocols. And, you know, Solidly has an uphill battle. It needs to attract the liquidity. The liquidity is already on Uniswap. So that's why this protocol has caught my interest to the degree it has. It's not like it's a new exchange coming online and it needs to incentivize or vamp the liquidity to the exchange. The liquidity is already here. This narrative, to me, hits more criteria that I think are favorable for it to be successful. And as Luke Roman says, let's watch. Shisha's in the house, a pleasure. Tapsy, hey, may we all live in interesting times. To suffice it to say, this is an interesting time. Circle has some deposits. Yes, I saw that as well. If we have a shakedown in centralized stables, how do you see the curve model moving forward? Just fine. Uh, it will be disrupted, not necessarily systemically, but there's going to be a shit show of volatility. We'll see. I'm not too. It doesn't give me anxiety. I would be interested in seeing what plays out. I expect some serious shit to go down. It's an existential fight with what's going on with New York, the Attorney General over there, what the SEC wants to do. This is all existential, but that just means exactly what Tapsy said: is this is interesting times to say the least, and I'm more comfortable than ever with the position. It's not a position, but the ownership quantity I have of the Curve protocol. I am prepared mentally for that ownership to not be valuable. Maybe the narrative I have acquired is not what plays out into the future, but we're diversified a bit. And we think about Friday and we think about our skills. And there's always something new. So we will traverse, we will proceed, we will navigate. And we will do the best we can do. So don't worry too much over wrong choices. That's the purpose of diversification. And the purpose of concentration is if you have high conviction and you think something has a higher likelihood of succeeding than failing. And, stop worrying too much. We'll see what plays out. Let's watch. Kill us, you're welcome. G Chad, Fed will raise 50. Cool. Raising 50 basis points is going to further put pressure on domestic U.S. liquidity conditions. Raising 50 basis points will bolster yields and encourage bond depreciation, which will support international liquidity conditions. And if you combine that with decreasing DXY, there's a good chance liquidity conditions are going to meaningfully loosen internationally. And that supports what I would say is a narrative where the crypto markets get a lot of attention from especially internationally favorable jurisdictions. If there's an excess or increasingly favorable liquidity conditions in a friendly jurisdiction, okay, you're going to have some good crypto market activity. Do I give a shit whether the capital inflow into the crypto markets comes from the United States or Germany, Britain? It's a catastrophe in good parts of Africa. Maybe South Africa has an absolute manic couple of months or a year. But what if there's capital flight? And the capital has to go somewhere. Maybe it goes to this relatively new market that is a market of markets. So there's reason to suspect and speculate that capital flows into this market of markets from many places. We know capital's been flowing in Argentina and distressed countries. We don't want the countries to be distressed, but this is all part of trying to assess the flow of liquidity. When there's volatility, when there's a distressed state of a country, capital has the desire to outflow, capital flight. Where's it going to go to? So, being a manager, your own fiduciary, you're trying to get your capital to where you think capital is going to flow. If you think capital is going to flow into uh, a resurgence of the German nuclear energy industry, you probably want to make an investment there. Why? Germany is the whole narrative, the reality that they don't have Russian energy anymore. Can they acquire coal and natural gas at favorable prices? Maybe they need to do a radical pivot. And where are they going to get their electricity from? So maybe Siemens is a great investment. ABB, large scale, societal scale engineering firms, and they do something to finance a massive rollout of the fastest series of nuclear power plants in modern history. You see, and then you first identify a narrative, you investigate, you test whether the narrative is even likely, and then you make a speculative bet. So for me, the most easily accessible speculative bet is the crypto markets as a market of markets. So this is where my capital belongs, being an investor and thinking about these things. There's a lot of risk trying to get capital into another country. You need a custodian. If you want to get capital into Germany, how do you even fucking do that? How do you get capital into Britain as being in the U.S.? Who's managing your money? Who's holding your money? That's what's so incredible about the crypto markets. My ownership of a crypto asset might as well be in Australia. It doesn't matter. It's not a country. It's everywhere. The same time, simultaneously. That's crazy. Raul, GChat, either raise rates or cut government spending. We all know government will not cut spending. Well, frankly, it's the other way around. Um, Either they issue a huge amount of debt or cut spending. How are they going to finance? What was it, like a $1.2 trillion deficit that the White House just put out? So they're going to need to open up the debt ceiling. They're going to need to raise, capital by issuing bonds, but that is going to depreciate bonds. Um, so this is, Luke Roman's wheelhouse with, just the system eating itself, the debt cascade. So let's watch. This is going to be some crazy shit. This is crazy times of resonance, volatility, resonance. They need to. The only narrative they have to raise rates is domestic consumer price inflation. But Yellen literally just said this morning, this inflation isn't monetary. It's disruption of supply chains. You know, politics is all about narrative and storytelling and convincing people of, logic and reason. They're literally convincing us of the logic and reason that they want us to believe. So if you all of a sudden see talking heads, the media, and Yellen and Jerome talking about, yeah, don't worry about this inflation. Once we fix the supply chains, the inflation is going to come down. We've done as much as we can with interest rates. It's okay. We're going to keep interest rates where they are, and the Fed is going to focus on figuring out how financing can get to the places that bolster the supply chain. And that's how we at the Fed and the Treasury and the executive branch are going to bring down inflation. So just watch how it plays out. You're going to see the stories that are spun that allows them to engage the policies and the processes that they think, one, the general public will swallow, and two, will produce the solutions they're looking for. So, I see in my mind greater reason that raising rates will further support risk market activity. It's a pressure that will increase liquidity conditions outside the U.S. And obviously, uh, the banking crisis we had this morning, that affects sentiment. So fear is a negative pressure. Obviously, cutting rates under market conditions is a positive pressure, but I would say cutting rates in these market conditions is a negative pressure because cutting rates right about now contributes more to the sentiment of fear than it does to increasing domestic U.S. liquidity conditions. You see those pressures there? Cutting rates increases domestic U.S. liquidity conditions, which is a supportive pressure. But if they're cutting rates right now, that is going to be a negative sentiment pressure, depreciative sentiment pressure. Raul, a pleasure. Asarco, hey Cap, need a dose of rationality today? Yeah, don't fret too much today. Adam, hey Cap, any thoughts on C2 from Convex hating on lit? Yeah, that's okay. Um, it's not related to curve. Um, it's not related. Two different systems that provide market making, that manage liquidity. As I've said, folks using Uniswap don't use aggregators. It's a very specific contingent of people that engage with Uniswap directly. It's, anyone who has any experience with the crypto markets is using an aggregator. And the best place is literally an aggregator of aggregators. This is the best place to go. And if you're not going to go here, you go to CowSwap. And between these two protocols, you're going to do what you want to do in the crypto markets with regard to getting the most favorable exchange rate. I mean, if you notice, these are stable coins, but if you go from Ethereum to Lido, CowSwap, maybe not, but CowSwap's in this list. So what's the point of going to CowSwap if you're going to get a favorable rate from Paraswap? In which case, this aggregator of aggregators, this meta aggregator, gives you the best possible rate. So Uniswap is not the curve narrative. Uniswap is the Uniswap narrative. Uniswap is the billion next people that have no experience with the markets going to the only place they know where to go. So liquidity needs to be there. And how do you get liquidity there? You finance the liquidity. So how does Lido finance the liquidity on Uniswap versus Curve? There is no way to finance liquidity on Uniswap until now with Lit and Bunny and Timeless. That's why that's meaningful. You can't just, they have to have managed liquidity conditions where people are engaging with the markets. And clearly, The more experienced persons are engaging with the market on Curve and the other AMMs, and but Uniswap cannot be ignored. Why can't Uniswap be ignored? Because of this. Uniswap is 61.6% of all volume. That's it. That's huge. So that's why, Adam, it's not the same story. I'm sure he was saying what he was saying from a convex slash curve perspective, which is fine and that makes sense. But this is meaningful. And if you go in a 1 inch, you're basically going a curve. All stablecoin swaps through 1 inch are going to go through curve and maybe some in Balancer and maybe some in Uniswap. But that's where curve gets its exposure from. I don't know what the hell Dodo is, but there's curve itself, 135 mil. Where's Balancer on here? I mean, look, here's all of them. There's Cow, there's 0x, which is Maca. Sushi Swap still has activity. Paraswap is a little baby. Balancer. So look, this is our balancer, or Aura balancer. Did a whopping 25 mil. So balancer obviously is coming in third place, very much third in the federation or the 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 archetype of AMMs with currency recycling regimes. So this is great context because obviously Curve is dominant with regard to offering third parties the capacity to finance liquidity incentive. Um, that's the dominant one. Bunny hits this giant narrative here of 61.6% of transaction volume. Of course, Lido and Liquidity, they're going to want to finance liquidity here. Why? Look at all the damn volume. Look at all those customers. And Balancer is microscopic. But Balancer has a unique offering. This is the innovation zone for the currency recycling regime. And we've seen why it's the innovation zone because they have traction. Their 80/20s are innovative on the VE concept. It's voter escrow, but you are not negatively impacting liquidity conditions because it's still liquidity. The VE is a deposit, so it's not draining liquidity. It's locking liquidity. So it's actually a very big innovation. So that's the deal there. It's very interesting how they settle in my mind with regard to systemic significance and how an AMM with 25 mil with all these protocols, which is it's not it's well-known protocols that have more volume than it, but you look here and you're like, even though it has a relatively low volume, why is it still very significant? Because of what it does with regard to its currency recycling regime implementation, its voter escrow implementation. Hope that helps. Let's see what else we can look at in the technicals. IPOR is very interesting. How do you hedge uh, a hold to maturity bond portfolio with an interest rate swap? So I'm quite fond of the IPOR position. It's not where it needs to be. I don't think it's very interesting to. Right now, they have speculative bets on stablecoin rates. That's not interesting. What's more interesting is speculative or hedging Ethereum, because Ethereum is in the crypto space. Ethereum is a bond that is risk-free, Ethereum denominated. Please take that very specifically. Ethereum denominated Ethereum is risk-free because if you deposit Ethereum, you're going to get your Ethereum out. It's not risk-free with regard to the dollar price. So be very specific there. So if you borrow against, your risk-free collateral, Ethereum denominated, all of a sudden you have overtones of traditional finance. So you deposit your Ethereum into a liquid staking derivative, and then you like FRX ETH, and you borrow FRX ETH, and you hedge, uh, um, and then you could hedge the interest rate. So if the FRX ETH depreciates, you're able to capture that depreciation, and you keep your collateral, and then you're able to re-up your collateralization health because the interest rate swap would appreciate, and then you could top up your health. Think in terms of a health factor on Aave. Your FRX ETH is depreciating, but now you could top it up so you're able to maintain a healthier debt position than if you just had exposure to the collateral and weren't able to hedge the collateral's pricing. Now, interestingly enough, if you put it into traditional finance terms, borrowing against FRX ETH is kind of like just continuously pricing it. It's continuously mark to market. There is no hold to maturity type of position in the crypto markets. Um, some, you know, some very smart folks, some of good friend at this point, I would say the absence of duration in the crypto markets is something meaningful that's lacking. Um, I think it's healthier for continuous pricing, continuous mark to market of collateral. In hindsight, maybe we'll say that this was the right thing to start with, and you don't have this. Concept of hold to maturity and duration. And it's just, everything has a price and everything responds accordingly in real time. Liquidations occur in real time, deterministically. And that's why this market is different. And that's why this market is interesting. It does finance different than traditional finance. That's a big deal. So I structured the IPOR position. IPOR position is obviously depreciated, but I structured it in such a way that I have, quantity of IPOR, but the quantity of stable coins I've deposited is growing the quantity of IPOR about 10% a month. And that's just what I have. And it is what it is. It's depreciated. The IPOR position is probably down about 20%. But the quantity of IPOR is growing from stablecoins about 10% a month. So we'll see. I like what they've built, and I think it's a meaningful systemic component that we know where we probably want it to head, but it's going to take a little bit more time. Aura has been remarkably stable, holding above $3. Obviously, it was up at 4 with a double top, and our events of late have caused significant depreciation, but there was a fair amount of buyers this morning that pushed it back up from 267 to almost $3. Great position. I'm going to relock it. And let's been hovering as well. I got in probably around 79, 80 cents, give or take, right around here when I saw it approaching its previous high. So it looks like we flipped the script here. It looks like the previous high is flipping as support. Support may come in. It might fall down, but whatever. At least it's an expression of support. A little something. Last couple questions. I do have to get somewhere. I still suspect downside to 17, but that's me. Yeah, I expect plenty of volatility. Shisha, USDC won't die, and decentralized stables will gain market share. We'll see. I think that is a decent argument. I did swap to LUSD this morning. Maybe that was just obviously fear that is spreading. Fear was warranted. Did I need to do it? Probably not. I still need to convert back to something that Juno or BitPay accepts. So there is going to be losses in that transaction process. So maybe it wasn't a good choice, but still is what I did. 31 people remaining on the stream, 17 likes. Thank you all. Appreciate everyone. Friday, March 10th at 12:38 p.m. Thanks everyone for joining. Tell everyone to subscribe. You know the deal. After party, always on Discord for the most rational community in the entire crypto space. Have a good weekend. I will see you on Monday. Peace.